today's topic is we're talking about transitioning from MVP to scale up and what Series A investment has to do with that. So there's 3 speakers today, but it's actually just me right now, and I'm waiting for Garrett to join me. I am a serial entrepreneur, and I've been a venture capitalist, and currently I'm an investment banker. So I have a broad amount of experience at both running companies and investing in companies, and that's the experience I'm bringing to today's talk. So Garibaldi's mission is to help Canadian technology companies to ascend to greater heights through our services. We help companies at a variety of different stages. So at the earlier stages of growth, we help companies with growth capital or introduction to investors or debt. And at later stages, we help companies sell their company. Last year, Vancouver Startup Week, I gave a presentation on the metrics that matter for invest and exit. And you can see last year was very different. It was an in-person event. And this year, we're going to talk about, first I'm going to talk about something I call growth capital fit. Then we're going to talk about something I call the traction gap. And then we're going to get into depth about raising a Series A. So the journey to the summit, challenge meets opportunity. So everyone has aspirations to be a great company, and most of it have it. It's quite simple. You have a great idea. You raise some money, you become a success. It's actually a little more complicated than that. The road has, a portion of it where initially you're trying to just validate the product, and that's what we call MVP. Then you go through a series of steps where we're trying to validate against the market and how we're going to sell the product before you can go into what we call scale-up mode. And in scale-up mode is we have a pretty defined glide path to getting to much higher revenue in which we scale that investors are very happy to invest money in. The challenge in this box in orange is that it's sometimes difficult to raise capital until you've got that right fit of proving that you have a repeatable sales model and that your revenue is predictable. So Series A tends to occur after everything gets solved in orange. You're only attracted to VC when they can do a certain type of math that says my investment in you, how that investment is going to be more valuable in the future. And that's very difficult for them to do until you establish these key metrics and traction. So I'm going to revisit that definition of traction later. But another way to look at this journey is that the road to success has a big pothole in it called the Valley of Death. So while you are busy making first product and validating that product in the marketplace and validating how you sell and how you bring and monetize, you are not profitable. So you're likely to run out of capital. And it's only once you've gone through all those steps that you can actually raise significant capital to scale. Right? And I call this, everyone knows what product market fit is, but for me, this is growth capital fit. And that you have to have a demonstrated growth glide path with demonstrated that these processes will work repeatably. And if that is occurring, then investors are happy to invest the capital. Okay. So I'm going to talk a little bit more about what this traction means, and we call it traversing the traction gap. And you can see in your journey, there's this big thing you have to overcome. So some interesting facts first. Less than 10% of companies that raise a seed round are successful in raising a Series A investment. A majority of Series A rounds are less than $9 million. The average Series A funding amount in North America is $15.6 million in 2020, and that's up from in 2010 when it used to be under $10 million. And median Series A pre-money valuation is $23 million. So as you can see from this chart just under here, cumulative likelihood of acquisition, the likelihood of exit doubles after achieving a Series A, right? So that's the most significant step in the evolution of your startup, is raising a Series A, because it takes you that much closer and faster towards your exit. For those of you thinking, wow, gee, 15.6 million is a lot of money. Well, the reality, that's just the average. If we look at this chart to the right here, we see that that there's some companies raising as little as $1 million a Series A, and others, a huge chunk of them, raising more than 20 million. What's typical of most US venture capitalists is they won't do a Series A unless you're significantly above raising more than $5 million, because of the way their funds are structured. If you're raising primarily from Canadian VCs, then you may be able to get them to put a Series A in with less money. But the challenge is for you to have a startup that's good enough and proven enough that can leverage the capital that they want to deploy, right? So if your plan doesn't have a plan on how you're going to use $8 to $15 million, then you might not be ready for a Series A investment. Okay. So what is a VC looking for? A VC is looking for leadership ability, strong team, clean cap table, innovative product, large serviceable obtainable market. These first 5 things are the why you're an entrepreneur in the first place, right? So you believe in your company, you have a great team, you set yourself up to be successful. The next 3 items I have highlighted here in blue. Do you have the traction? Do you have the proof that if you spend more money on marketing, you convert more customers, and how successful you are converting them? And do you understand, if you had more capital, how you'd use it to win in the marketplace, right? It's those 3 parts that I'm going to focus on here when I'm talking about the traction part of getting you ready for Series A. Okay. So what is the traction gap? Well, the traction gap is basically the period between your initial product release all the way to you having what we call minimum viable traction. Okay. So that means that you have proven enough about how you can capture customers and how repeatedly you can scale up your sales team, that an investor is willing to put a significant amount of capital to get you to accelerate to the next level, right? So that's the MVT, right? So you're going from initial product release all the way to MVT, which is minimum viable traction. That is what's required to raise a Series A. Now, this is all well documented in a book by Bruce Cleveland, who's a VC at Wildcat Ventures. And they're a Series A investor, so that he really understands, what a Series A investor looks for. And this is why it's a great book for you to read if you're someone that wants to raise a Series A. To go into a little bit more detail, here's what's going on. So once you get to an MVP, and everyone's going to debate exactly whether you've achieved MVP, but it's the minimum product that you can actually get repeatable sales with, right? Then the minimum viable repeatability is that you have the repeatable sales, repeatable success. In other words, customers are satisfied and come back and buy more, and they don't churn. And you have repeatable scaling. In other words, if you double the amount of marketing and double the amount of salespeople, do you double the amount of revenue? Does the scaling math work? That is minimum viable repeatability, right? And it's only once you surpass minimum viable repeatability as a VC can consider you seriously for a Series A. Okay. So some of you may be familiar with the term crossing the chasm and wonder how that differs from the traction gap. The crossing the chasm is really about how ready the market is for your product, right? So sometimes products are too leading edge and the market doesn't understand them. So only the very, very early adopters are actually buying it. And then once you get the market understanding the value your product creates, that's when you cross the chasm and then you start to get into the mainstream market, right? The traction gap methodology is more about how ready your company is to capitalize on that market. But for you to truly scale, you have to be across the chasm, right? So there is a dependency on the crossing the chasm model, but in terms of the traction gap model, you have to have gotten all your in-house processes in place to be ready to scale before you're actually traction ready. Okay, so there are 4 pillars you need to address to be ready to scale, right? Right, to truly have traction. The first one is your product is adoption ready, right? So in other words, a customer can buy it and deploy it without you having to write any special code to let them to utilize it, right? So they can adopt it easily, they can buy it easily, and they can get success easily, right? The revenue operations piece is that you're optimally ready to monetize. In other words, it's easy for someone to buy it either from you or from a channel partner. It's easy to transact. It's a well-defined way that you fill your funnel and that people evaluate the product and then progress to buying it from you, right? On the team is you have all the right people in the right roles so that someone's handling selling, someone's handling deployment, someone's handling customer satisfaction. All these people in the right. And then systems, you have processes that can scale, whether it's from collecting money to supporting people to whatever you need to do in order to keep this engine running. Okay. So now we're getting to Series A. So now, assuming you've actually achieved traction, the next thing you want to do is once you raise that capital, let's say it's 10 million or $20 million, whatever amount you've raised in your Series A, you're now ready for this very steep ascent up the mountain towards the next level, right? So you're going to be going fast and furious to use that capital to win in the marketplace. So the first part, you there, Garrett?
Yeah, I'm on. Let me know if you can hear me.
Yeah, why don't you take this section on?
Perfect. Thanks, Jeff. Yeah, and so I'll just get you to flip through the slides since you're the one with the screen share. But what are the major pieces you're going to need to show to venture capitalists to raise that Series A? The major piece is that you're winning business from consistent customer types. You're winning in a specific segment, or you're winning in a specific customer size, and you can show that as repeatable revenue. We've used this type of marketing strategy to have them come inbound, and we are using this sales strategy to bring them from either a test trial onto the product that they're paying, and we're monetizing it. Whatever that is, you need to show that you've got a revenue sources that are growing and can continue to grow in the same way. And that leads into growth trajectory, which is that you're showing this subset of customers is paying continually more and more. So, you've got a customer count that's growing. You've got either, new product features that are rolling out that are expanding your dollar per customer, so that you can show you're on the right path towards, higher revenue each month to month. In addition to this flows into having strong financial metrics and customer metrics. So keeping track of your KPIs, so whether the amount of growth that you have going forward, whether it's 30% year-over-year revenue growth, or it's monthly year-over-year growth, that this is sustainable because of other metrics such as your churn metrics. So when an investor looks at you, they know you're winning a certain number of customers, but you're not losing too many at the same time. Or it's your the acquisition costs to acquire those customers aren't too high. And the last two pieces are great ways to showcase this to investors and show you're sophisticated in knowing where your business is going, and that's the financial model and the growth plan, which oftentimes can be paired with an investor presentation or an investor deck. But in the background, these two pieces have to be in place. So your financial model can easily map out, where the revenue is coming from before, what are your customer segmentations, how much dollar per customer. It's very metrics based so that they know, what was the past churn, what are you forecasting going forward. And then when you pair that in with your growth plan, you can make those assumptions justifiable in your financial model. You can go to the next slide, Jeff. So, when I speak to pairing the comprehensive growth plan with the financial model, that is what's going to give you a compelling and convincing growth strategy. So, you've started winning customers in a specific market. You've been told by customers that there's the correct market fit for it. Then you've started determining, what is my product strategy going to look like, and what are the features that'll need to be new. And you've been able to verify that these new features are, going to have an uptick in the amount of dollar you can get out of each customer. So then those can be clearly shown within your financial model as, hey, in this year, we've invested this many dollars in research and development, which are going towards a new product. But then also, what is the dollar that we're getting per customer? Those are increasing over time. And so you can see that my growth strategy is working correctly, and that we are expanding into this market. And then we've learned new features that are going into new markets, or whether it's specific APIs, so you can win customers that are already on, Salesforce partner networks, or whatever the plan is, it needs to tie to that financial model to show that your growth is actually moving off of some justifiable assumptions. Next slide, Jeff. And yeah, exactly. So the financial model is where you can really prove all of this, show sophistication to an investor, also allow them to test some of your assumptions. What happens if you don't hire a certain number of marketing people? What happens if you don't invest so much into R&D? What happens if you don't win the number of customers that you're going for? So not only is it convince them of, what your growth targets are for the company, it also allows them to see, quite easily what happens if they don't quite meet those growth targets. What if their path isn't quite as high, but it's nearly there. You show that you have a level of readiness for this, and you have built out all of the assumptions, all of the metrics, all of the sophistication to get your business to that stage.
So I'll add to what Garrett had said, in that you have to be not only very good at telling the story about how all these pieces logically fit together to keep you on the growth curve, but you have to understand, one of the reasons we show the hockey stick here is this hockey stick growth is sometimes difficult to believe unless you have the numbers to support it. And that's why the financial model is so important. You have an ambitious plan to show that the math actually works. And that's, what we have a lot of challenges with the VC sometimes is making them understand the math, because at their core, they're doing math to figure out whether they should invest. And you're an entrepreneur, you're thinking differently. You're thinking about your passion and your belief in the marketplace. So these can only meet in the middle if you have a good financial model.
Right. Thanks, Jeff. Yeah. So, the next piece is, how are you actually going to go about making these targets, and what are some of the considerations you have to have along the way, and considerations that, Series A investors might also have and might ask of you. So, first off is some of the challenges you might see along the way on your scale up. So having consistent growth here at the top is a big one. If you're working with smaller dollars, it's easier to grow quickly off of it. But companies quickly see that maintaining the growth that they have is quite important through the scale up stage, and it allows you to achieve the same value for yourself and for your investors as you grow along the path. As you start to grow, keeping track of all of that revenue is also additionally difficult. You're going to have to start having documentation on, your best practices and your sales strategy and on the operations side of it. So having early penetration into different markets and being successful in your sales to them is going to be increasingly difficult as you begin to grow and you begin managing more customers. In addition to this, having the right capital at the right time is extremely important. One of the things that we talk about a lot when we speak of the hockey stick is it's often not the smooth curve. It looks like almost a step function where you have, a bit of a plateau, and then you're raising capital so that you can go after these endeavors, and then you might have, yourself further along the hockey stick. So making sure that you are planning for raising capital at the right time so that you don't stall out and essentially have, too long of a plateau in your revenue and can continue to move up your curve. Evolving targets and threats as well. As I was mentioning before, your story might say that you're going to move into different markets, or you're going to move upstream to larger enterprise customers. But what you might find at that point is that there's an increasing number of competitors in that space as you begin to expand who you are selling to. So you might find yourself going up against large, S&P 500 companies for their customers as you begin to sell into their market. So being aware of, what are the increasing threats to your business, and, the bigger target you're essentially going to have on your back from competitors as you start to grow. Maintaining operational excellence at scale is kind of similar to what I was saying before, but having the right people in place so that your operations can scale efficiently is going to be very important and needs to be, aligned with the strategy in your business. And, it's kind of unique to every single company is going to be very different. And so you need to make sure that all of your different strategies you have in place kind of align to each other. Next slide. So how does Garibaldi help with some of this? And so I'll go over the Garibaldi Academy for you guys. So essentially we're at a stage right now where we're in this kind of learn bucket. So the Garibaldi Academy kind of focuses on 3 different stages of companies. You've got earlier stage businesses that we're looking to, help educate on, the tools needed to raise Series A, kind of pre-Series A companies. So we offer webinars, online resources, we have access to these slides, and can sort of, help companies understand the entire realm of what's required to go through the scaling up process. This applied skills part will focus more on, companies that are approaching that Series A raise. They're targeting that within 6 to 9 months. They're starting to see some revenue, and where we would come in is having workshops, whether it's on financial modeling, whether it's on building your investor presentation more hands-on, and then also consultations. So one-on-one, if you're looking for advice on, product strategy, or you're looking for advice on your, sales strategy and your pricing plan, we can pair some of these companies up with consultants that we have access to with Garibaldi. And then last but not least is strategic development. So once companies have that Series A in place and are looking to, put that money to work, scale the business, move towards whether it's a Series B growth equity stage round or looking to exit from the business, this is where we will bring in a full-scale consulting program for them so that we can, go after all of the various targets for revenue growth. We can have, industry experts in different areas of the business, take a deep dive to understand how we can get that revenue growth to the point that they're looking for. So, as I mentioned a little bit in the last slide, how do we help at all these stages? So, on the startup side, we've got network-based coaching. So, being able to put you in contact with the right individuals who can have you, go after the right areas of your business. We'll have downloads for all the historical sessions. So we've had sessions such as this one, as well as previous ones that we've presented through SFU and other organizations. Peer meetings with executive coaches, workshop-based coaching. So this is something that we're going to be moving into in terms of, building your financial presentation, building your investor presentation, and building your financial model. Having templates available to companies, whether it's investor pitch decks, whether it's sales plans, pricing plans, that sort of thing. And then on the scale up, this is having a dedicated coach. So this would be a full consulting arrangement where you would hire a consultant on retainer. We would provide a valuation analysis so you can get a sense of, where are my metrics at this stage? What would investors, how would investors or purchasers value my company? And, what levers can I pull to improve those metrics and improve the valuation of my business?
So now we'll move to using the chat function to try to answer some questions. While you're doing that, why don't you tell people, Garrett, about the workshop you're planning for people that want to do a financial model?
Yeah, for sure. So planning to have a full-scale financial modeling workshop where we would focus on best practices, not only for how to model in Excel most efficiently, best practices for making it easy to read for an end investor, some of the differences and pitfalls that many CEOs and CFOs have in building a financial model, as well as the importance of making it metrics and SaaS oriented, or if you're not a SaaS business, making sure it's still metrics oriented and having all those pieces in place so that investors can clearly see where all of your assumptions are coming from and where growth is coming from and at what points in time. So yeah, we're targeting this event in I think late October to early November, looking to have sort of a room full of 4 to 6 interested participants, and then the types of modeling that we'll go into will be determined by who's in the room, so we can tailor it specifically to that.
Okay, so are there any questions about what we talked about today? We'd love to have a discussion. If you could just post your question in the chat. So I mentioned in the chat that if you contact Garrett, we'll make the slides available to you. But the Banker Startup Week is also providing archive of all the video recordings. So, Garibaldi Capital is not a VC. We're an investment bank, so we'll provide connections to VCs. We also, for companies at Series B and beyond, will actually help raise money for a fee. For earlier stage companies, we just will introduce you to the right people and give you a list of investors to go talk to, and that's really up to you. And we don't do that for. If we can make a couple introductions, there's no fee. If you want us to do a research, all the investors that have invested in companies like you around the world, then that will take a modest fee. Okay. So how do you define startup and a scale up? So like we explained, once you get past that traction gap where you have repeatability, then you're beyond startup, you're a scale up.
Yeah. In terms of benchmarking yourself to a scale up, it depends on different industry groups, but oftentimes we see companies at this level when they've got sort of 1 million in annual recurring revenue, but it's highly dependent on are you going after small, medium businesses? Are you going after a large enterprise? So if you're going after really large, chunky contracts and you maybe have 2 contracts at 1 million in annual recurring revenue, you're probably not at that scale up stage because you haven't shown repeatability in your sales cycle, your ability to win, business on a recurring basis, with either through your partner channels or either through your, account executives. But at that point, you'd still be in the startup stage.
Yeah. So if I could go back to this slide, there was a question on, what are the fees? So a lot of the stuff we just do for free, and that's we provide public seminars like this one through Venture Labs and through a number of the incubators, accelerators across Canada. The ones in green is where we're rolling out next month a membership-based service. So basically, to get access to a whole bunch of resources, you'll pay a fee, and I believe the fee is going to be $149 per year. And basically, you'll have access to all our templates and data and resources that'll help you self-serve yourself. It will also set up some special sessions for those members to get access to key experts in certain areas, such as polishing investment decks and things like that. The scale up program is very different. It's very personalized. So we actually bring in a full-time coach who will coach your company through the scale up stage, and that can cost anywhere from $3,000 to $8,000 a month, depending on what your company's trying to achieve. Does that help answer the question?
And I think there's a question there's 2 different questions. There's one on us doing IPOs, but there's also another one on minimum viable category, just the concept of that, and is it necessary for reaching traction?
Yeah. So for VC to get the return on their capital, if you went public on a small market exchange, it's very unlikely there's enough liquidity for a VC to get out and get a return on their capital. So they will they're only interested in IPO that's going to take them to NASDAQ or the New York Stock Exchange. So a VC has a requirement to make 10 times their money, and they have to have a certain amount of certainty that they can do that, right? And small public markets like the TSX or other small exchanges, either in Australia or the UK, just aren't practical for most VCs. And they're actually very dangerous for most tech companies, because unless you have extremely, extremely high growth, there's a chance that you can stall, and it's very difficult sometimes to finance once you've already been public.
Yeah, I guess the interesting one on that, specific investors and funds being available to invest only once you are publicly listed. A lot of them have very large minimum check sizes. So you're talking about, people that are running pension funds, and so often their order books on, IPOs on NASDAQ or New York Stock Exchange are in tens or hundred millions of dollars. And, they're also not looking to be the only investor at that point in time. So it's often on very large deals that they're willing to go in, and, TSXV listed companies often don't quite hit that criteria. So it's better off to be an extremely high growth company, can, attract some of the smaller funds or retail investors, and, use that liquidity event to not so much continue or expand their growth, but just to continue their growth. And then that second question on, Jeff, maybe you can touch on this a bit more, just the importance of, defining a category or almost changing a category before you get to traction, and what's the importance of that?
What was the question again?
It says, can you expand more on the concept of minimum viable category? Is this a necessary condition for reaching minimum viable traction? And why does a company need to achieve this as opposed to just operating better in a pre-existing category?
Because ultimately, trying to join a pre-existing category for a startup stage is very difficult for you to compete with the other companies that have raised a large amount of capital. Generally, you're looking for white space, where a category where there isn't a lot of big players for you to dominate as that market category expands. If the market category already exists, let's say it's a Fitbit competitor. If you're going to compete with Fitbit, it's very difficult as a startup to outcompete, Fitbit. Okay, so if you want to email us directly, our emails are right here on the slide. Is there any other questions related to the content we presented today? Okay, some of the questions that are remaining, it's probably best to just reach out to Garrett directly via email if you want to engage him in discussions on your specific opportunities.